throw. The cryptocurrency market was rocked by one of its most dramatic events in history, as Bitcoin plummeted by more than $10,000 within a single 24-hour window. This sharp decline began after the asset failed to maintain its psychological support level at $70,000, triggering immediate panic among investors. The primary catalyst for this flash crash was not merely retail selling, but a massive wave of liquidations within the derivatives market. As the price began to slide through key technical levels, thousands of high-leverage long positions, bets that the price would rise, were forced into automatic closure by exchanges. This created a devastating domino effect. Every drop in price triggered new liquidations, which in turn forced the price even lower. In just a few hours, billions of dollars in open interest evaporated, effectively flushing out what analysts often describe as the weak hands of the market. This phenomenon highlights a significant shift in Bitcoin's market structure, where derivative instruments like futures, options, and ETFs now exert more influence than spot transactions. Market experts note that Bitcoin's price is increasingly driven by synthetic supply dynamics and institutional risk management, rather than just on-chain scarcity. The heavy involvement of institutional players using high leverage has made market volatility more extreme, turning what should have been a standard price correction into a paralyzing systemic sell-off. Market sentiment further deteriorated as negative rumors began to circulate, including concerns over global macroeconomic stability and the health of major trading platforms. This uncertainty was compounded by a broader risk-off environment in traditional finance, where other high-risk assets also faced simultaneous selling pressure. During this period of chaos, Bitcoin's narrative as digital gold, or a safe haven asset, faced a rigorous test, as many investors chose to exit all risky positions in favor of holding cash to weather the broader financial storm. The characteristics of this crash also brought back collective memories of the liquidity crises seen in previous years. Despite the massive scale of the nominal losses this time, the way the price sliced through thin order books showed that market liquidity remains surprisingly vulnerable to sudden shocks. Analysts warned that as long as the market is dominated by excessive debt-based speculation, similar accidents could recur at any time, even as the fundamental narrative of institutional adoption appears to be strengthening. However, amidst the ruins of the liquidation event, the market eventually showed its characteristic resilience as institutional buyers began to accumulate Bitcoin at the $60,000 level. Shortly after the crash, the price showed signs of a rapid recovery, attempting to reclaim lost ground. The event serves as a harsh reminder to all market participants that Bitcoin has evolved into a complex financial instrument that is highly sensitive to capital flows, leverage cycles, and global monetary policy.